We're still dealing with the ramifications of the recent real estate bubble. Wouldn't it be nice if we were able to predict bubbles before they pop and wreak havoc on the economy? Well, our next guest says that we can. Joining us from Los Angeles is Jonah Lehrer. He's a contributing editor at Wired and author of How We Decide. Jonah, thanks so much for joining us. Appreciate it.
Thanks so much for having me.
So basically, you're saying that we can use science, and specifically neuroscience, to try to predict the next bubble, whatever it may be. How exactly does that work? Walk us through it.
Well, this is research led by Reed Montague at Baylor College of Medicine, and his experiments are pretty straightforward. Essentially, he takes people, puts them in a brain scanner, and exposes them to past market bubbles, things like the NASDAQ of the late 90s, the Nikkei of the 80s, even the Dow of the 1920s. Then he watches how the brain responds to these bubbles, and he's pulled out some really interesting data points, I think.
And so what happens in the brain before these bubbles?
Well, not surprisingly, when the market starts to increase, when people are first watching condo prices increase in Vegas, for instance, they get very excited, and you see parts of the brain that are associated with rewards, things like the dopamine reward pathway, light up. So far, so obvious. You know, it feels good to make money. But what's really interesting is that right before the bubble crests, so right before it bursts, Montague has found this small circuit of cells which seems to anticipate the fall. It seems to anticipate the fact that this is too good to last, that it simply can't last. And so it's telling us, this small circuit of cells is telling these investors to get out before it's too late. The bad news is that the vast, vast majority of subjects in these experiments don't listen to these cells. They're so enthralled by the rising prices that they convince themselves that this bubble is actually a boom, and so they end up losing lots of money. What Montague has found, however, is that those investors who would have listened to these cells, who could have heard this small circuit warning them to get out of the market before it's too late, they would have earned more than twice as much money as those who didn't listen to them. So I think the real takeaway is that there is this small circuit of cells which seems to know more than we know, which seems to warn us before it's too late. If only we could take a moment and listen to it.
Well, how do we do that is the question, because obviously there's this long history, whether you're talking about economic boom and bust or, you know, anybody who's ever been in a bad relationship, that you don't listen to the little voice. So is there sort of scientifically a way to train people to do that?
Well, I think this research has a couple practical implications. The first is that I think it actually could become a diagnostic tool. I mean, one thing Montague, at this point, he's just joking, but he says, you know, if he were running Goldman Sachs, he would buy a bunch of brain scanners, put in current prices, and see if you see the circuit of cells start to get worried. That we can use the tools, the fancy gizmos of neuroscience to perhaps identify bubbles before it's too late. So that's one practical takeaway, is that these tools could become practical tools and help us diagnose the next bubble. Because as you noted, you know, the history of finance is largely the history of financial bubbles, from tulip mania in the 17th century to the recent real estate bubble. So this is something we clearly have to understand. It's really important to understand the roots of bubbles in human nature, and I think that's what this research is helping us do.
And indeed, we're looking at a graphic right now of the sort of boom and bust economy, the history going all the way back to the Great Depression and the crests and falls that we have had very regularly. I'm curious, in his research, or if any other research has been done, when people know that they are attached, obviously it's not hidden, they know that they're being scanned, does the behavior tend to change at all as a result?
You know, I mean, that's a really important question, and it's a question that shadows so much of this brain scanning research. Yeah, I think what Montague might say is that because people are playing for real money, they get to keep their earnings, that hopefully you mitigate a lot of the, you know, the effect of doing these kinds of experiments, that people get to walk out with the money they want, so they've got a real incentive to try to maximize their profits, just like in a real market. Some other interesting phenomena that Montague has observed is that when people are competing against each other, so he calls this a country club effect, bubbles tend to become even sharper. So people are even more likely to take really dumb and stupid risks, at least risks that look stupid in retrospect. And he compares this to being at the country club, and you hear about how much money your friend is making in investing in condos in Florida, and so that leads you to take risks that normally you might not take. So you can begin to see how these very human flaws are exaggerated by other people, how we try to out-earn, our neighbor down the street, and that leads us to make some very, very reckless decisions.
And of course, it's Wall Street's a very competitive environment, so it's hard to sort of change that. I'm also curious about the role of high-frequency trading in all of this. If you're sort of taking out a lot of the human component, because as we know, so much of the trading now is done with computer programs that are driving it, does that take away some level of predictability from doing these kinds of brain scans?
I mean that's another really important question. I think to the extent we can take out these human biases, these flaws which have been hardwired into the mind, that's a good thing. I think it's still also important to take into account, though, that it's still humans programming these software programs, that there still is a human element which is embedded in the software. And I think it's very dangerous to simply assume that there are these programs which are smarter than we are, that there still is a human element out there. And I think as I've learned in the last couple of years, one always has to have that human element questioning the assumptions that these trading programs are using. So if those underlying assumptions are flawed, then the software is only as good as those assumptions. So on the one hand, I think we have taken some steps to mitigate these human biases. On the other hand, I think in the end it's going to come down to people being more self-aware, people being aware that our decision-making is dictated and shaped and warped and influenced by all these software programs inside our mind, inside these 3 pounds of meat. So we have to be more self-aware of the flaws we all have so that we can take steps to avoid them.
I love that, the 3 pounds of meat that constitute our brains. Thank you so much, Jonah, for talking with us. Appreciate it. Jonah Lehrer is a Wired contributing editor and author of How We Decide, joining us today from our Los Angeles bureau. Thanks again.